All right, everybody. Good night. How we doing? Good, good, good. I'm waiting for the camera light to give us the green light. But I am excited about the guests tonight. Brian, you brought people out to the meetup tonight that we haven't seen in a couple of years, so it must be something super special that we gonna cover tonight. Well, first of all, I want to commend you on the historically the longest running investment conference in the nation, right? Which would be the New Orleans
Yeah.
Investment Conference since 1970,
1974. This is our 49th year.
49th year. Okay.
I did not start it. A man named Jim Blanchard started it in the early 1970s. He actually was instrumental in getting gold legalized for American citizens.
Okay.
A lot of people don't realize that back then, before the end of 1974, it was illegal for American citizens to hold gold bullion. I mean, you could hold it in rare coins or jewelry, but it was up there with heroin and plutonium as things you were not allowed to
Wow.
own, and illegal. And Jim did, and he was a great friend of mine and some other people in the audience, actually. And he saw when Nixon in 1971 severed the last remaining tie between the gold and between gold and the dollar. Back then, foreign nations could send their dollars to the U.S. Treasury and get gold in return. So the Bank of England, the Bank of France, Charles de Gaulle in particular, saw that after a decade of guns and butter and overspending, deficit spending, that the dollar wasn't worth what we said it was, and they were sending all of the dollars over and taking all the gold out of Fort Knox. And it couldn't last any longer, so Nixon just said, nope, we're not doing that anymore. Jim heard that and decided and knew that that was going to usher in a wave of inflation, which became really the 1970s. And there was no way for American citizens to protect themselves because they couldn't own gold. So it was like and FDR actually did that. He made it illegal to own gold and got America off the gold standard. And it was like guiding the Titanic toward an iceberg, but before you did it, you threw all the life reservers and lifeboats,
Right.
over the side and gave people no way to protect themselves. So he was successful in 1974 getting gold legalized, decided to have a conference to teach Americans how to invest in gold, and that's what I'm running today. I went to work for Jim as a junior copywriter in 1985, and he sold his coin business, bought it back, sold it to management, and that was running it, and took the conferences and the newsletters in me, and started a new company in 1990. And he passed away in 1999, and I bought the majority share I didn't already own from the estate and have been running it ever since.
Gotcha. So what we want to try to accomplish tonight is try to clash the world. So our group is mostly real estate investing, and I think a lot of people would agree with me that we picked this lane of investment for two reasons: for the net worth addition and also for the cash flow. So tell us about precious metals and how precious metals can kind of fit into that strategy of building up a net worth and cash flow at the same time. From your lens, how does precious metal fit into that strategy?
Yeah, typically precious metals doesn't end up, or gold and silver bullion being monetary metals don't affect cash flow. There are ways you can do that though, and some innovative people are coming up with ways to do that. Innovative people who are actually involved in the real estate market. But the important point, I think, for real estate investors to understand is that, like real estate, gold is a tangible asset. It's a physical thing. It exists in the real world, and it has value that appreciates in terms of the ongoing depreciation of the currency. In this case, for everyone in here, the dollar. The dollar is relentlessly depreciating. Even though we don't have a rate of inflation like we had in the 1970s, it's recently been much higher, but it is still depreciating, and at a rate typically that the government doesn't want you to know the true rate of depreciation. So real estate, like precious metals, protects against that. Gold in particular just sits there, doesn't do anything, doesn't earn interest, but it acts as an anchor or an insurance against that depreciation. There's a great website out there called pricedingold.com, and the person that runs that website has taken various asset classes and indices and things and just basically discounted them by the value of gold. So let's say he takes the value of that index or that asset in 1930, divides it by the number of ounces of gold at that point in time it would take to buy that or to equal that, and then does the same today. So if you do that, you see that the Dow Jones Industrial Average hasn't budged for 60 years. You see that the price of an Ivy League education is the same today in the amount of gold that it takes to buy it as it was in the 1930s. You'll see that the price of a Big Mac since the 1980s has actually gone down in every other currency in the world if you price it in gold. So gold is the standard that all the other values revolve around. And there's a lot of reasons for that. We can get into a lot of the history, et cetera, but the basic reason is nothing else operates like gold as a physical representation of work, of value. Currency and money was invented because if I wanted to get your chicken, I didn't have time to go dig a ditch for you. So somebody paid me to dig a ditch, and then I took that money and I paid you for the chicken. Gold was a representation of that. Nothing else was useful for that because gold was immutable. You can't tarnish it. You can't destroy it. It always exists. And it's good for nothing other than that. I mean, it looks good, but it's really not used in any other industry that's in appreciable amounts where it affects the value of the end product. That's all it does, but it does it really well. So that's kind of gold's role is that insurance. And that's why I tell people who are looking to get involved or wondering why should I buy gold, it's insurance against something that is going to happen. It's an inevitability. You have home insurance, you have insurance on your real estate holdings, but you don't really expect a fire, do you? You don't expect a flood. Well, maybe around here you do, but you don't expect a fire. With gold, you know that in 3, 5, 10 years, the dollar is going to be worth an awful lot less than it is today. But gold's going to be worth the same. And what that dollar did, it isn't that the gold rose in value, it's that the dollar depreciated in value against gold. So you're taking some of your wealth and you're just anchoring it. Now, there are ways to do things with that gold. And, I've worked with the real estate guys, Robert Helms and Russ Gray, and started speaking at their events, and they became kind of gold bugs and devised a way that you can take bullion holdings, take some of your equity out, invest in gold, then loan against that, and then produce income, passive income against that. And I would advise anybody to look to them for how to do that. But they're getting back to why you invest in gold. There are really two reasons. One is that insurance, which I just mentioned, and the other is investment. Now, if you look at what gold does as far as inflation, people say that gold, the naysayers today say that gold really isn't an inflation hedge. And they're right, it isn't. You look at the CPI, and gold does not track the CPI tick for tick. But what it does is when people get really worried, when they essentially freak out about what's going to happen to the purchasing power of their currency, then they rush into gold to get that protection. Then gold makes up for lost time, and it really recovers that lost ground. So when you look at the macroeconomic picture, and you say, well, that argues for higher gold prices. There are ways you can leverage that macroeconomic picture in ways that you can protect yourself. That's why there's a big relevance to real estate investors. If you look at what's going on in the economy and where we're headed, and you say, well, that's going to make tangible assets appreciate a lot more relative to financial assets, then it's good for you. It's good for real estate, the real estate market. And it's good for gold. And so there's a lot of overlap between the two. And there are ways you can obviously leverage both.
Yeah. So when you say gold, paint the picture for us. Are we talking Pirates of the Caribbean with gold coins in a treasure chest under the bed? Or are we talking casino with gold brick stuff behind a Mona Lisa picture? Or are we talking investing in companies that mine and buy gold? So to paint the picture of what it looks like to
Yeah.
invest in gold to get these benefits that you're talking about.
There's a wide spectrum, and even with every little class along that spectrum, there's another wide spectrum. So you can get as complicated really as you want. But I tell people who are just getting involved, first thing you need to do is get some physical gold and silver. Those are really the monetary metals. I think platinum and palladium have lost any monetary, cachet that they used to have. They're more industrial metals now. Even silver is getting a bit industrial, but those are the ones you need to focus on, and I would say own both. Own the physical metals, put them away someplace safe. I don't want to know what it is. You should not tell anybody where you put it or how. You can also store it in storage facilities and do your own research on that. But own some. Protect your wealth, everything you've gained today. If you have big cash holdings, put some in gold and silver because the cash is depreciating, the gold and silver is not. So that's the first thing you need to do. Now, if you think the macroeconomic picture says that the gold prices, or actually the dollar is going to fall in relation to gold much more drastically in the near term, then you can look into more aggressive ways to own it. You can buy the paper the ETFs, which are basically funds that hold physical bullion, and that's a representation of physical bullion. You can do futures and options, but you really better know what you're doing there because that's very risky and that's more trading than investing. And you can invest in mining stocks. Within that small sector category of mining stocks is another broad spectrum from big producing companies that produce gold and silver to junior companies that are really the hair and fire casino end of the market. That's kind of what I specialize in with my newsletter, actually. But these are companies that are exploring for precious metals deposits and deposits of other metals and minerals and the like. So that's an exciting area, but it's not an area for widows and orphans. It's an area where you really want to learn the sector and not invest in anything you really can't afford to lose. So there's a lot of ways to leverage those trends within the precious metals. We have a special report on our website on goldnewsletter.com. You can actually get it from NewOrleansConference.com, which is our conference website. And it's called The Investor's Guide to Gold and Silver. It doesn't sell anything that I'm selling or anything, doesn't really promote that. It tells you all of the best ways to buy precious metals, the best conferences to go to, the best newsletters to subscribe to. It really is a comprehensive report that explains everything, but it can get as complicated as you want.
Yeah, and that was going to be my next question. Until we could get to the newsletter for now, what is one of the most credible ways that you would share with us to actually buy this stuff? Because there are a couple infomercials in between Wheel of Fortune and The Price is Right about buying silver and gold for 89 cents. What's the credible way to buy it? Yeah,
and those commercials aren't for free, by the way. And so if they are paying for those commercials and they're selling you bullion at spot, at melt value.
And what's bullion?
Bullion is a gold coin or bar or silver coin or bar that is it is just solid gold or solid silver. In gold, it can be 0.99, it can be 0.999. Same thing for silver, just as pure as they can make it, and you are physically just buying the metal. It is strictly an investment in the metal. And that has a value. If you buy it, you're going to pay, let's say I don't know what's a good example. Let's say X is the melt value of that. When you buy it, you're going to pay X plus 3 or 4%. When you sell it, you're going to sell it at X minus a couple of percent. Very narrow profit margins in bullion. Now, the U.S. Mint makes coins. They cost a little bit more because they are the U.S. Mint. And there are companies that will sell you proof versions of these, special collector versions of them. Those aren't bullion, and they're really not even collector's items. But if you're going to buy gold or silver, just get the basic coins or rounds or bars. And it gets a little more complicated than even that. But the ads that you see on television, don't buy from those companies because they say they're going to sell to you at their cost. And what they're going to do at that point in time is they are going to get you as a client, and they are going to hound you to all ends of the earth to get you to buy special collector versions of those bullion coins or rare U.S. coins. Now, rare U.S. coins, called numismatics, is a hobby. It's a collectible, and it is a valid way to invest, and it's a interesting way to invest. But it's not bullion. It's not strictly precious metals. It's something that unless you get into it as a hobby, you're not going to make money in it. Unless you find a trusted dealer to give you advice, you're not going to make money. But if you buy that kind of stuff from a company that's advertising heavily, you're almost definitely not going to make money. Yeah. But they will call you up, and they will twist your arm for the rest of your life to get you to buy rare coins, because their margins, their profit margins on those are closer to 30%, whereas in bullion it's like 3% or 2%. So that's what those loss leaders or kinds of programs are for.
Yeah. So if we take our cash that we made from real estate and we do put it into gold and precious metals, what could we expect, or how could we expect to exchange that for value? Let's say when the dollar gets to its absolute lowest value, at that time, are we getting to the point where we're selling housing cars for X ounces or X bars or 4 bars of gold for Escalade, or what could that look like?
Let's hope that doesn't happen. Mm-hmm. One of the weird things about being involved in precious metals market is you see these trends and where they're heading, and you start to develop theories and ideas about where it's all going, and you hope that you're wrong, because if gold is selling for $10,000, $15,000 an ounce. I was joking with one of the guys that is really the smartest guys in the investment world. He sent me an email. He says, well, here's to $25,000 gold. And his name's Jim Grant. He's very widely known in the industry, one of the smartest, most eloquent guys out there. And I wrote him back and said, Jim, yeah, when gold's selling for $25,000 an ounce, we're going to be lighting our cigars with $100 bills with our assault rifles draped over our laps. Some things you just don't want to happen, but some things you need to prepare for. And I do think, though, that there is a long-term trend in play that is very easy to see. For example, in my presentations, I always bring up a chart of the Fed funds rate, which is basically the short-term overnight interest rate that the Fed sets. It's how they set interest rate policy. And if you go back to the early 1980s when Volcker killed off inflation by raising interest rates over 20%, that's what it took to kill off inflation. And at that point, it was all downhill. I mean, naturally at 20%, you had to normalize things. But from that point on, whenever there was a recession or any kind of a potential recession or slowdown in the economy, the chairman of the Federal Reserve and the Federal Reserve Board, the FOMC, would lower interest rates. That was their standard operating procedure. They would make money easier. And if you look at that chart of the Fed funds rate, you can see that when they would cut rates, they would cut it down to here. Then they would try to normalize it, but they could never get it back up to half the midpoint of the previous range, for something would happen in the markets and they would have to lower it again. So in my chart, I put a little red line on the bottoms of those interest rate cycles, and you can see over 40 years it's just step down, step down, step down, step down, until it got to 2008 and the great financial crisis. And at that point, they went straight to zero, and that wasn't enough. So they had to do things, and they'd never done that before.
Yeah.
And then they had to come up with things like quantitative easing and TARP, and basically inject money at that point into Wall Street to protect the banking system and the financial system. So they kept lowering rates lower and lower and lower, and then they just started throwing money out there, creating money. And the point being that people say the markets are addicted to easy money, and they're not. They're addicted to ever easier money. So in each instance when there's a crisis, they have to do more than they did before, because like an addict, the markets have become tolerant of the drug, and so you need a greater dosage to get the same effect. So then, they did all this crazy stuff. They took the Fed's balance sheet from $500 billion to $4.5 trillion. And then they tried to bring it down. Then came COVID. Interestingly, before COVID even hit, 6 months before COVID hit, they started quantitative easing again, kind of on the sly. They said, no, it's not quantitative easing, we're not doing the same, but they added another $500 billion to their balance sheet. And then COVID hit, shut down the economy, and the Fed acted. And everything that they did post-2008 over 4 to 5 years, they did in 4 to 5 days. Mm-hmm. So they brought interest rates right down to zero, and instead of just injecting money into Wall Street, they just put it in people's bank accounts. They injected that monetary adrenaline directly into the veins of the economy.
You talking the stimulus right now?
The what, I'm sorry?
The stimulus?
Yeah,
during
the stimulus,
COVID? Okay.
everything. And the stimulus checks, the other programs they did to, and granted, it was a crisis.
Yeah.
They needed to do something. But still, to get the same effect and keep the markets going, they had to do much more than they did before. So these are cycles. And every time the Fed reacts to a crisis, they overreact. This is all human nature. And then by overreacting, it's like, it hit me a while back. I was going on a boat ride with some other couples, and we're going down a canal, and my friend's in his boat, and he has to go do something. He says, can you take the wheel? So, yeah, I'm standing there, so I grab it with one hand. I've got my beer in the other hand. Okay?
Oh, man.
And we're just putt-putting in a slow rate of speed, but a lot of you can probably appreciate that you start going toward one side of the bank. So what do? You turn the wheel. And all of a sudden, you're heading directly toward the other bank at a harsher angle. What do? You turn the wheel even more, and you get for the other bank. So what the Fed does, it has been doing, is every time it goes into one crisis, it overreacts and creates the next one. Mm-hmm. And then it overreacts and creates the next one. So the great financial crisis, we had zeroed interest rates for about 8 years before they started to try to normalize things. And they couldn't get too far before they had to go back again. And then there was COVID. And these things are happening, it seems like, more and more often. My kind of operating theory is that we have this trend. We have this long-term trend of ever easier money, of people, humans, with all the frailties of human nature, being in charge of running the economy. And by nature, they're always going to get a little bit looser, and think that they know better and try to manage the free market, which of course is no longer free. Yeah. So over time, they get to that point where with every crisis, they have to do so much that even people like us that aren't kind of attuned to what's going on, even everyday people on the street, start to realize that, hey, there's going to be another crisis. They're going to create a whole lot more of these dollars. I better spend it now. I better, get rid of it now. I don't have any respect for it. In other words, the currency loses credibility. And when that happens, the only way to really restore that credibility is by finding something to anchor that currency to say, well, this is worth that in this thing. So what is that thing? It's throughout human history, throughout 5,000 years, it's been gold. Mm-hmm. So very likely it's going to be gold again. So I don't know, and I don't think anybody does, whether that end point, that kind of great reset of the financial system is going to happen 5 years, 10 years, 20 or 30. But if you look at where we've gone with ever easier money, you can see that we're headed toward that. And it just kind of feels that these days the water's going a little more quickly around the drain, and things
Yeah.
are happening more quickly. So that's why I tell people, you really need to protect against, what might happen and what seems very likely to happen. Nobody knows, and you shouldn't believe anybody that is going to tell you where the economy is going, because it's too complicated, there are too many variables, nobody is that smart. But I just feel you can be confident that the dollar, given this long-term trend, is going to be worth a lot less in coming years. So you can protect yourself with gold and silver. You can protect yourself with real estate. I mean, y'all are the experts in that. That's one way to do that. Gold and silver is another way to do that,
Yeah.
and it's complementary.
Yeah. So I guess asking it in a different way, if we are prepared and we have those cash reserves in those metals, if the dollar is going down, what's the method into where we can exchange those values? Are we at the point, will we get to the point where we have to exchange gold for gold, or?
Yeah, no, I think at some point there will be an official exchange rate for the dollar to gold. There are a lot of ways to do it, and there's been a lot of arguments about you can't have a gold standard anymore, it's too restrictive. Well, no, you can. The reason why politicians and bureaucrats and the PhDs that run the Federal Reserve don't like a gold standard is because it takes away their power and it makes them accountable. So let's say, today, if you were to say all of the dollars in circulation are backed, only 20% of their value is backed by gold. Not full coverage, just 20%. That would imply because there's so many dollars out there, that would imply a price of gold of $10,000 an ounce. It's currently about $18.50 an ounce. So you're talking about a big increase in the price of gold. And that's only a partial coverage of the dollar. If you got to that point and said 1 ounce of gold is worth $10,000, and then all of a sudden government did what they have continued to do, they overspend, create more dollars, et cetera, and the dollar cheapens, then at some point they're going to say, well, today it takes $12,000 to buy an ounce of gold, and they just devalue the dollar. The thing that gold does in that instance is it makes them tell you what they just did. They can't do it gradually because of slow depreciation with inflation and the like. They can't blame it on the person in front of them. They can't blame it on the person behind them. When they devalue because of their bad policies, it will be out in the open and everybody will see it. And that is the beauty of gold. You can still use it as an anchor to the economy. It's going to be like a governor, a restriction on this natural human nature to overdo things.
Yeah.
To overspend and be, make more dollars than have more dollars than cents, basically.
Right. You use the term that precious metals is a wealth insurance.
Yeah.
What do you mean by that?
Well, if you're worth, $1,000, then you probably want to have, and just coming up with numbers off the top of my head. And I'm not a registered investment advisor, I can't give individual investment advice, et cetera, but you would probably want 5 to 10 to 15% of your wealth socked away in precious metals. So if you had if you had $100, you'd want $5 in gold or silver. And there are a lot of ways to look at it. Now, looking at gold and silver tends to outperform gold in a bull market. So silver is a way to get natural leverage to gold. But I would not advise anybody to own only silver and not gold, because in that kind of if there's a reset of the dollar to gold, I'm not sure they're going to bring silver along. So you just
and this is physical. Your suggestion is physical metals.
If you can, I think you need to have to your comfort level a bunch of physical metals. And you can add to that as insurance by getting some of these ETFs that are out there. I recommend something called the SPROT, S-P-R-O-T-T, Physical Bullion Trust, because I know the people that started them, and I know that they're diehard gold bugs, as it were. They're really advocates for freedom and gold and silver and precious metals, and they actually buy the metals. So those are the best things, the Sprott Physical Gold Trust and the Sprott Physical Silver Trust. Those are the ones I would recommend, and not some of the big ones that Wall Street has put out, because I just don't trust the ones that Wall Street has put out.
Yeah, understood. So as far as the dollar losing its value, if we want to make sure we're more educated and don't strictly rely on what the news is saying, what indicators or what measurements can we pay attention to compare that the dollar is this much lower than it was last week or 10 years ago or 5 years ago? What is that metric that we could pay attention to or Google or keep an eye on to realize how deep it's falling?
You're kind of forced to use the CPI,
and what's CPI?
The Consumer Price Index,
Okay.
that's reported by the government. Now, keep in mind that the government has an incentive to use that to point toward lower inflation than you're actually feeling. They use a lot of highfalutin adjustments. They use something called the hedonic deflators. They use substitution, and basically they talk out of both sides of their mouth. They say, well, if steak gets too expensive, then they'll eat hamburger. That's substitution. So you don't really have a difference in your quality of life. But on the other end of it, they say that cars today, because we all have power windows and great stereos and and all these other advantages, that they're much better. And so they're actually cheaper than they were years ago. So they're really talking out of both sides of the mouth because they don't want to pay the cost of living increases on Social Security and everything else, and they just don't want to look bad. So that's a government indicator. We can kind of look at that, you and I, and say, things are a lot more expensive than what the government says they are. There are some people out there. There's a guy named John Williams who publishes something called Shadow Stats that goes back to the old ways of the way the government used to calculate the CPI in the 1970s. They've changed it twice since then, and each time, coincidentally, it's reported lower inflation each time they've changed it. But John goes back to the old way, and he says, when they say inflation is 4%, it's closer to 8 or 9% or more in real life. But if you're trying to get a reading on it, that's kind of what you're forced to use.
Okay. And you would just Google CPI, just like
Yeah, it's a widely watched number on like CNBC and Fox Business, some of the financial channels, and yeah, you can keep track of it there. There are a lot of alternative media out there. If you can get on what's called, well, it's on Twitter or X now, but there are a lot of people on there that are talking about macroeconomics and the like that are really, really smart. And they'll tell you things that you won't necessarily find on mainstream media. You just have to take in information from across the spectrum and use your intuition and try and see who's right and who's wrong. But don't believe anybody that tells you that you should not be listening to this.
Yeah.
Or don't close off your mind. A lot of the information out there is out there in social media, but primarily on Twitter/X. There's a lot of good stuff.
Yeah. So I know you can't make predictions, right? But historically, I know you're in this space a lot, as far as interest rates go with the Fed using that as a form of a stimulant. Historically, where are we at in the historical cycle that you could think of from past behaviors, and what do you see historically could be the next behavior that has already happened?
Yeah, I'd have to say I have been very impressed with what the Fed has done. I did not think they could get to where they've gotten on the interest rate because the debt is so high. Jerome Powell wants to be Paul Volcker, who killed off inflation in the 1970s. He really idolizes the guy. He wants to be known as the Fed chair who killed off inflation. But he doesn't have Volcker's toolbox. Back in the 1970s, the federal debt was about 35% the federal debt was 35% of the gross domestic product of the U.S., the value of everything produced in the U.S. Today, the federal debt is about 125% of that. You know, much, much higher. And because we're paying interest on that federal debt, and in fairly short-term paper that rolls over and adjusts to the current interest rate pretty quickly, we're paying right now about $1 trillion in interest on the federal debt at these rates, and it's resetting because it's still lagging a bit. So we're going to be paying well over $1 trillion over the next couple of months if interest rates settle at this level. That's more than we pay for national defense. It's more than we pay for any other line item in the budget. And if it keeps up, that's going to swamp everything else combined. So you just cannot have interest rates this high when debt is this high. So it's unsustainable. What's going to happen is something's going to break. You know, we just got out of the easiest money, the cheapest money, monetary policy in human history. We were talking 5,000-year lows on interest rates at 0%. Some countries had negative interest rates on the government paper. And to switch from that very quickly, the flip of a figurative switch, to one of the harshest tightening cycles ever seen, it stands to break not just one thing, but a few things. So, you know, you have banks under stress, you have corporate bankruptcy soaring, you have all of this happening. The bottom line is the Fed really wants to keep rates this high for longer, but something is going to break. Something we know, because again, these are these cycles, it's the way it works. Something is going to force them to lower rates again. And when that happens, depending also on where inflation is at the time, but when that happens, you're going to have stocks are going to soar, you're going to have gold and silver are going to soar relative to the dollar, you can have real estate soar, everything is going to take off. And you can almost feel these markets. Every now and then, they read the tea leaves, they read what the Fed governors are saying, and they're just like a horse that's chomping at the bit in the starting gate. They're ready to go. First sign that the Fed's going to pivot, they're going to take off. And all of a sudden, they have these false starts. You got to put them back in the starting gate because nothing happened. So that's we do know that there's going to be another something out there that's going to cause the Fed to start lowering rates again. We don't know what that's going to be. There are a lot of options, a lot of candidates for it out there. I've been saying that it's probably, it almost always is, something out of left field that nobody's really talking about. I think that the crisis in the Mideast and Israel might be that something that came out of left field that might prompt the Fed to hold back or even reverse course.
How does unrest like that, historically, how has that impacted precious metals in particular?
Not well, because people buy, and I always advise for many, many years not to buy gold. You'll see something happens around the world, you see the price of gold spike up. There's no reason why that should happen. It's just rank speculation. Somebody thinking, I'm going to buy it now purely so I can sell it to somebody else at a higher price, you know, the greater fool theory. And what happens is you're not the first to buy it, and you're not the first to sell it, and you end up losing money, and only the most nimble of traders is able to make money on something like that. And there's no logical reason why that should affect the worldwide price of gold. This instance is a little bit different because, again, we're looking ahead to seeing what's going to cause the Fed to stop this really harsh monetary policy. And if that crisis escalates and spreads, then the Fed is definitely not going to hike rates into something when we have a couple of carrier groups that are launching planes. They're not going to hike into that. And in fact, that could cause enough unrest in the system that they may have to actually pivot and try to rescue the economy with lower rates. That could happen now. Again, nobody really knows, and you can't look to experts to tell you because there's just too many variables. You have to just play the probabilities and the things you're confident in as far as the big picture and ways to play it, because the details, the specific path ahead is going to surprise everybody to some degree.
Yeah. If there is a real estate investor in your space, maybe that's spoken at the conference that you do respect, what behaviors have you seen them to be successful? Where they've been able to take all of the cash that they earn in real estate and still be able to be successful and put together a good ratio of metals and the cash from real estate? What does that look like? And maybe we could kind of mimic what's a good model, a better way to put it, where a cash-heavy investor and has some type of knowledge with precious metals. How do they merge those worlds together and make a blended portfolio?
There's a number of, over the last 10 years, we've had the real estate guys who produce a podcast on real estate, real good friends of mine now, that have started coming to our conference and bringing some of their followers and listeners to our event. So we've been starting to focus a bit on real estate, and I've got to meet a lot of, people like all of you in the audience and people listening who are really entrepreneurial, self-made, independent thinkers, and they kind of get it because, again, there's a lot of overlap between real estate and other physical investments like precious metals. And they've started buying that, and they've built up accumulations. I don't know relative to their wealth how much, and I don't ask, but they do it. One of the biggest advocates out there is Robert Kiyosaki, who's gotten to be a friend of mine over the years as well. I've had him speak at the conference a bit. And he is about as ardent of a gold and silver bull as you'll find. And that's what he does, real estate and gold and silver. Robert may actually buy more than I would recommend for anybody because he's got an awful lot. Well, he's Robert. But he's an avid bull. He gets the whole concept of it, and you can do both. And there are ways, there are very few, but there are places that will loan you money against your bullion holdings. It has to be held in a third-party custodian, et cetera. But in other words, you can free up that equity and put it back into real estate and get your income as well for a portion of your bullion holdings. So it's somewhat limiting, but it's not to any exclusion of being able to still have access to capital.
Yeah. So tell us about entry level. So right now, if we do want to diversify, if we do want to apply that ratio of 30% or 15% of what we have parking in metals, for the everyday person, what is the gateway drug to getting into precious metals?
Gateway drug is cheap silver, I guess. One of my favorite ways to invest is in something called junk silver, which is old silver, dimes, quarters, half dollars, even dollars that were minted years ago by the government. The government still puts silver into the coinage, still puts 70% by weight of silver into the coinage. And so when you buy those coins, you can get like a small dime, you can get a small quarter, which is worth money in silver. In one way, it's a hedge against the kind of thing that I was talking about that you don't want to see, like a barter system where it's really an economic crisis and nobody's taking dollars anymore and they just want precious metals. But if you have a 1 ounce gold coin that's worth thousands of dollars and you want to buy a loaf of bread, they're not giving you any change. But if you have a silver quarter, you might be able to make that useful. So I like those old, they sell them in bags, and the numismatists, the coin dealers, call them junk silver because in their mind they're ugly. They've been worn down, they've been used. To me, that gives them character, though. You can look at these old coins, they're really neat to look at. Yeah. And sometimes it's the cheapest way to buy precious metals because there's no manufacturing costs. The government already paid for that years ago. But in other times, for all those other advantages that they offer, it's expensive relative to their silver value, their melt value, as it were. So you got to kind of play that game. Coin dealers will tell you, and I will tell you, the time to buy physical metals is when you can, when nobody else is really rushing to get it, because there's a limited supply out there. Who would have thunk it, but government mints aren't the best business people. Mm-hmm. So when there's a big rush, they just wipe out all the supplies, they wipe out all the manufacturing capacity, and they don't really raise it to meet demand and everything, because they're just, they work for the government. So the time to buy it is when there's not a whole lot of demand out there, because when something happens where there is a lot of demand, immediately goes out and it wipes out all the available supply, and you pay a higher premium. That's the cost above the actual melt value. So sometimes you buy a 1 ounce silver coin from the U.S. Mint, American Eagle. It might be, Wayne can probably tell me, $5 over spot now or something like this. If silver's $20 an ounce, it'll cost you $25. At one point, it was like $15 an ounce or more, and over the melt value of silver, because there just wasn't any out there, and you had to pay more to pry it out of those hands of the people who owned it. So the time to buy it really is and to accumulate it is when you can, and not in an emergency basis, because you can buy a lot more if you're careful about it and just have like an accumulation plan.
Yeah, we'll prepare for questions a little bit. Still got a couple more questions. In our industry, paper with the bank showing, how much we work, cash flow is important to us. So how is the amount of gold that we own, how is that depicted on paper to show a net worth? How is that measured? Do we put that on a P&L?
If you have that in a third-party custodian that gives you a report of this, we're storing this much for you, you could bring that to a bank, and they may go out and audit it. And there are very few, and there's more coming, banks that will, again, loan you money against that bullion, but they'll also audit that and make sure it's there. The gold and silver that you have buried in your backyard, hidden in your walls, in your safe at home, I don't want to know again, but wherever you have it, you don't want to put that on paper anywhere. That's one of the beauties of it. You don't want anybody to know that you have it. Don't tell anybody. I tell my kids that when I die, they're not going to know where all the gold and silver is. They're going to get a treasure map. And you got to have some fun with it. So hope you can find it. Figure this out. But yeah, you're basically, when you're buying gold and silver, one of your goals is to get out of the system. So you don't necessarily want all of it, and I would say you don't want all of it in the system, on your balance sheet, on your P&L. You want it where you know where it is and just about nobody else does, because the dollar is in the system, the dollar is depreciating, and the government always seeks more control over what you do and how you act and how you invest and everything else. That's why they have the tax code. That's why they're eventually going to try and have a central bank digital currency, so they can track every dollar that you make, where it goes, and they can direct the dollars that you make to do what they want you to do. With gold, you're opting out of that system. With gold and silver, you're saying, I want to be independent. Gold and silver on a very base level is freedom. It's independence. You're insulating yourself from how they're screwing up the money. Yeah. The currency, rather. Gold is money.
Tell us about the New Orleans Investment Conference. So if we're real estate guys and we go to this conference, what could we expect to learn? What's the value add for us?
You will have some real estate-oriented content, but not an awful lot. A couple of presentations there over the 4 days, and some real estate opportunities in our exhibit hall. But what you'll learn a lot about macroeconomics. We'll touch on geopolitics a little bit. We've got this year we've got Matt Taibbi, who is I think the most important journalist of our generation, who kind of exposed the Twitter files and how government was censoring social media during COVID and other times. We've got some of the best macroeconomic thinkers out there. You know, I've been in this industry for, God, an awful long time. I'm reminded of it every morning when I look in the mirror, but I've been in this business for decades and decades. I've seen thousands of speakers. I've read thousands of analysts and commentators and over the years. And if there's one talent I have at this point is I know who's really good, who puts off a sound, cogent argument, sometimes not even an argument I agree with, but something that I recognize, hey, they could be right, and that's important. I know who they are, I follow them, I read what they say, and I've got all of them. There might be one or two that I was not able to get this year, but I've got dozens of speakers coming that you really need to hear from. I mean, some of the smartest people I've ever seen coming to this event. I don't know how many people would be familiar with people like Brien Lundin, who's the smartest person, one of the smartest I've ever seen. George Gammon, who does a lot of great work on YouTube on macroeconomic education. Jim Rickards, Danielle DiMartino Booth, Rick Rule, Peter Bookvar. It goes on and on and on. And you will get your mind opened if you come there. It will be taking in information through a fire hose.
Yeah.
You know, obviously I recommend it. I'm talking my own business there, but it is one of those things that will change your perspective. And it's not preachy or anything like that. It's hard facts presented about where we are in this economy, and a lot of it kind of mirrors what I'm talking about this ever easier money and how the government manages the value of money. And, you know, pulls those levers on the economy and the repercussions of that.
Yeah. So before we take audience questions, how do you define macroeconomics, and what's an example of how the macro kind of impacts us hyper-locally here, not just in the nation, but southeast Louisiana, Gulf Coast?
Yeah. Well, I think the most prominent example of that is interest rates. You know, what's going on around the world, what's going on in Washington, D.C. and the greater economy, what's going on in the halls of the Federal Reserve has direct impact on all of us here. You know, there is no true free market. There is no true capitalist economy or system in the U.S. because there is a group of PhDs who sit in a room every 6 weeks and determine the price of money. And if you determine the price of money, you determine the price of everything. So they are really pulling these levers on the economy. And yeah, it's not quite like a Soviet planned economy, but it's not a difference in term, it's a difference in degree. And government always seeks more power and more control, so it's not going in the right direction, it's going toward more control. So really the intellectual arrogance that people can determine better than the free market what the optimum rate of interest is. I mean, we would have gone through COVID, and maybe there was a need for an influx of capital liquidity because the economy shut down. But the free market would have adjusted very quickly to that. When risk goes up, interest rates go up. When risk subsides, interest rates go down. And it adjusts itself. But what was your question? I'm sorry, I kind of got off there.
So the definition of macroeconomics, the way you perceive it, and how it impacts Southeast Louisiana.
Microeconomics is like our economy right here in the greater New Orleans area and things like that. Macro is the global, the bigger picture, the larger forces. But those forces do affect each and every one of us, and it's primarily that driver right now is through interest rates. But then again, you know, it's through fiscal relief efforts. It's through what the Federal Reserve did to try to rescue the banking system in 2008. There are other things that they do. One of the important things that people need to realize is that over that 43-year or so trend where they had ever lower interest rates, the economy and the markets in every investment market became more and more dependent on Federal Reserve policy You used to be able to judge where the economy was going. You'd get all these data points. The only thing that anybody looks at right now is what's the Fed going to do. That drives everything. So instead of stocks going up and then bonds going down, that's why people used to say you'd want a portfolio of 60% in stocks, 40% in bonds. Because everything's being floated on this ocean of monetary liquidity, everything rises and falls together now, depending on what the Fed is going to do. So that 60-40 blend in your portfolio doesn't make any sense anymore. Everything moves together. And it's all being driven by this group of PhDs sitting in a room. And that's it. So, you know, if you look at macroeconomic analysis, there's lots of details and get very complicated about and everything else. But at bottom, it all depends on what people think they're going to do. And Jerome Powell can say 2 or 3 words and move markets. You know, he can't send an aircraft carrier to the Mediterranean. But other than that, he's the most powerful person in the world.
And Jerome is who?
He is the chairman of the Federal Reserve.
Okay.
Yeah. Unelected, by the way.
Wow.
Yeah.
Okay. So macro is big picture, and it impacts us basically by the news predicting what could or could not happen.
Yeah, and what the economy is going to do in its interest rates.
Yeah.
That's their primary tool, although they have found other tools and created other tools. Quantitative easing, where they just create money out of thin air. And they say they don't, but they are. And but otherwise, their primary tool has been interest rate policy for decades and decades.
Yep, I think that's a good segue to take questions from the audience. Any questions? Yep.
When you talk about these PhDs, are you talking about PhD economists? Are you
Yeah.
talking about at these universities?
Yeah. And these are not people who have even run a lemonade stand, by the way. So they.
So what they come together and they put these theories together, and I guess for lack of better words, what do they actually do and how do they actually talk about?
I may be the wrong person to ask if you want a serious answer, but I can tell you that they have thousands of economists working in offices and probably a lot from home at the computers, the Federal Reserve System. And they are making obscene amount, like $200,000 a year average salary or something like that. And they are compiling every data point they can get on the U.S. economy. And frankly, some of it very important. But then they get their staff to analyze all these key metrics and tell them, each member of the Federal Reserve, there is a dozen or 13, it might be 16, I can't remember how many voting members there are on the Federal Open Market Committee, which is a subset of the Fed governors and Fed presidents at the various Fed banks around the country. And they gather every 6 weeks and they vote on Fed policy, whether they're going to raise interest rates or lower interest rates. And to do that, they have their staff who is taking all these data points and they're reading these tea leaves to figure out what's going on in the economy. And that staff has their staff below them that is gathering all this information and giving their opinions. And that staff has their staff underneath them. And they're getting paid an awful lot of money to do all of this. And then they sit in that room and they decide better than, because they know better, because they've been to these universities and gotten these degrees and never had to make a payroll in their lives, never had to run a business in their lives. But they studied a lot and they know better than millions of people out in the world making their own independent decisions in their own interests, whether they should buy this or buy that, whether they should invest in that or invest in this. That creates a free market that automatically adjusts. And actually, the best way applies all the resources where they need to be. And they think that they're sitting up there with their degrees in a room. They can decide that better than all of those millions of people making millions of individual decisions every day.
So for the average person out here, let's say, especially real estate investors, so are there any sources like periodicals, books, or whatever that you can kind of gain some of this knowledge and this action?
That's a good question. As far as
Gold newsletter.
Gold newsletter, yeah, thank you. I got to promote my own newsletter. Yeah, you can subscribe to my newsletter. That probably is. I mean, if you think I know what I'm talking about, and I'll be very, frank and humble about this. I'll tell you what I believe and what I think is going to happen, but nobody can read the future. Nobody knows for sure. And I've seen lots of people. I've paid a lot of people to go to the stages of my conference and give their predictions. And you have to gauge it all and play the probabilities. But Gold Newsletter, you can go to goldnewsletter.com. That'll give you my opinions on what's happening in the economy. But social media is a good place too. Primarily Twitter/X. There's a lot of people on there that you can follow that are talking about all of this. And for a quick guide, if you go to my conference website, neworleansconference.com, I'd love to see you all there. It's November 1st to the 4th. But if you just look at our speaker roster, then go find those people on Twitter/X and start following them. They are the smartest people out there that I've been able to find, and they're really good.
Very well. Thank you. When you say something's going to break, in my lifetime I have read about the 1929 recession or depression, rather,
Yeah.
worldwide. In my lifetime, I saw the 2008, 2009 reset, and I saw COVID as major events, economic events. What's going to break? Do you expect a major recession anytime soon? Are the interest rates in real estate
Going higher?
going to go higher? Is it inflation under control? Those are questions that I have.
Yeah, I keep in mind again, nobody knows. My belief is I think that this interest rate cycle has peaked, essentially has peaked. There might be another quarter point hike at some point over the next few months, but I think that the markets are sensing, the investment market, stock market, bond market, and the like, are sensing that it has peaked, and that's why they're like the racehorses in the gate, just ready to go for any sign that rates are going to start dropping again. So yeah, I think they have peaked as far as Fed policy goes. Interestingly, the Fed talks a good game, talked really tough, and the markets actually took them at their word and more so. So they added about 1 percentage point to interest rates to Treasury yields over and above what the Fed had intended. So the market itself kind of tightened because they thought that, they demanded, in other words, a higher yield on government paper. So the markets themselves actually told the Fed that rates actually ought to be a little higher if you're going to sell us this junk. So long way of saying, a complicated way of saying, I think interest rates aren't going much higher from this point in time. I think something in the system is going to break because debt is so high that we cannot endure interest rates at these levels.
All right. Thanks for all the information. It's been really good. I wanted to ask you, you've been in the business for a long time, so you got a lot of information on that. I'm going to ask two parts to the question. What is your why? What makes you provide this information? What kind of keeps you going to build your knowledge on that? And
Good question.
Yeah, I got involved in this because I was very naturally libertarian oriented when I was young, and reading a lot of things and reading a lot of science fiction and the like. And then I met Jim Blanchard, who is the most amazing, charismatic individual you'll ever want to see. And we became pretty good friends because we had a lot in common. And I did not know what, say, a libertarian was back then, but he kind of exposed me to that. And you know, personal liberty, freedom of choice, free markets, sound money, and all that. And just, you know, I read a lot. I attracted to words in a row, and I read everything, and kind of developed an idea of, I can see this is what's happening. You know, you see what's happening, that's a big trend. And I guess kind of got a little pretty passionate about it. If I had to do it all over again, if I had my younger self, I would do what you guys are doing, what y'all are doing. I mean, I started getting involved with the real estate guys at my conference again about 10 years ago, and going to their events and seeing people who are doing what you all are doing. And it is the surest path to, and of course the devil's in the details, you all know that, and there's ways you can mess it up. And overextend it and everything else. But if you go in it with eyes wide open, you take examples, you hedge your risk, you can build financial independence and even generational wealth. I mean, not easily, but surely. It's just a matter of following the plan and doing it right. And I would do that. I think y'all are brilliant doing what you're doing. And it's a natural outgrowth of people, I think, who want to be independent and are smart. How's that for a suck up to the audience?
Next question.
I know you said to buy gold when you can. As real estate investors, we're kind of programmed to buy at a discount.
Yeah.
So is there a way to buy gold at a discount, or time the market to buy on a dip, or do you just go against our normal thought pattern and pay retail price?
Yeah, you have to understand that the beauty and drawback of gold is it has a price the world over that's quoted everywhere, and you can sell it any time of day, if you virtually any time of day. It is not as liquid as some things, but you can sell it, and it's going for the going pricing. If somebody gives you a discount on gold bullion, you're getting cheated somehow. It's counterfeit, or something else is going on. You can buy more during dips in the market by the simple basic function of dollar cost averaging. If you set aside a certain amount of money each month, and you should do this even for stocks and everything, any other investments. If you just put away a set amount every month, when prices go down, you're buying more of it, and then that helps you again when prices go back up. When prices go up, you're buying less of it. So you're naturally doing that. There are times when, if you're doing that plan, you should not buy gold because the premiums, or silver, because the premiums have soared so high that it doesn't make it that much sense, and you might have enough already. And when supplies are plentiful or easier to get, and the premiums, the cost over the bullion value, the melt value drops, that's when you need to be more aggressive and, again, get it while you can.
Next question.
So you mentioned earlier that, I think you were saying that the debt was 35% of the GDP
Yeah.
back around the 70s, and it's basically going up fourfold over.
Yeah.
So how has the price of gold, or how has the blank price of gold reflected that value?
Yeah, great point. And this gets a little bit more advanced, but you know how I told you about that chart, that website, pricedingold.com, that tracks everything over time, and you can see that priced in gold, all the prices have stayed the same, because against the value of gold has kept the value, or gold has kept up with the escalating prices of everything else. You know what the one asset, as it were, the one thing that gold has not always kept up with is? Federal debt. If you look at that same chart of gold versus the federal debt, and keep in mind, when they take the federal debt, this guy takes the federal debt and he divides it by kilotons, thousands of tons of gold to get something that can actually plot on their chart. But you'll see that the value of the federal debt in gold will go up. And then all of a sudden, there'll be a sharp trend, and for about 10 years, it'll go down. Then it will go up. Then about 10 years, it'll go down. And if you look at what those 10-year periods were, one was the 1970s. And that's when gold had one of those catch-up periods where all of a sudden people were realizing, hey, the dollar is going to hell quickly. I need to buy gold, and gold catches up.
Yeah. Well, Brien, I appreciate you coming out. I know it's a little bit different from a
It is
humongous New Orleans conference, but we always here if you want to come see us again. And everybody give a round of applause for
Thank you.
Brien.
Thank you so much.